Friends, you can now offset all your business losses, absorb all capital allowances, and carry forward all balances to eternity. Yes, friend, you can now relieve all business losses, carry forward any unrelieved business loss to eternity. And not just business losses, you can now also carry forward any unabsorbed capital allowance or capital loss to eternity. So what does that mean for you? You can now take more risks in your business. And if they do not go well, the new tax system is there to support you and cushion the effect on you and your business. The new tax laws do not only permit you to relieve that loss fully from future profits, but will not tax you or your business until you guys begin to make profit. How about that? Nice? Right. Similarly, you can now acquire as many assets as you desire, incur more qualifying capital expenditure on assets such as software and other intangibles, and even tangibles such as motor vehicles, buildings for your staff, and you can be assured that you will fully recoup your entire investment or expenditure on the capital assets through unrestricted capital allowance before tax authority begin to disturb you for tax. Is this not nice? Massive tax incentives in the new tax laws. Tax Corp have told you times without number that these new tax laws are good. For one, they contain so many tax incentives such as unrestricted losses and capital allowances. The new tax laws were crafted in fundamental principles, modern thinking and practice of tax, the exigencies and realities of modern business. They are compassionate, progressive, equitable, pragmatic, modern, simple, and significantly certain. They comprise what obtains in modern climes and therefore should be collectively supported by all. Similarly, just like in other climes where tax revenue is transparently managed and accounted, we should also advocate and insist for such in Nigeria. In this compass, in this video, we will provide and strongly clarify the provisions of a tax act over losses, loss relief, qualifying capital expenditure, and capital allowances so that you can harness them to significantly reduce your taxable profit or income and thereby reduce your tax liability. We will help you to deepen your awareness, knowledge, understanding of the various benefits that come with the various incentives and goodies, obligations and requirements, and some tips on how you can harness loss relief and capital allowance to your advantage and benefit to reduce your tax and to pay less. So what do you do? Just be calm, attentive, focus, and follow us to the end of this video. For what you will learn in this video will certainly wow and benefit you. Among others, you will get to know the golden rule of tax freedom, the fundamental meaning of loss and capital allowances, the golden rules of loss relief and capital allowances, the key and specific requirements for granting loss relief and capital allowances, and many more. We are going to be releasing these videos so as to assist, educate, and enlighten the tax community and non-tax community and stakeholders. All you need to do is to just follow us as we release them. And to get the videos hot and fresh, kindly like, subscribe, hit the notification button, and share so that as many people as possible will be notified and sufficiently educated, and your life will never remain the same. So what are you going to learn in this compass? You are going to learn the key goodies of loss relief and capital allowance in the Nigerian Tax Act 2025, the golden rule of tax freedom, fundamental meaning of loss, the golden rule of loss relief, important consideration in loss relief, fundamental meaning of capital allowance, the golden rule for granting capital allowance, singularization of capital allowance, type and rate, meaning of qualifying capital expenditure, and the 10 types of capital expenditure, types of non-qualifying capital expenditure, meaning of wholly and exclusively in golden rule definition, key considerations in determining wholly and exclusively, key essentials for granting capital allowance, claiming and granting of capital allowance, classes and categories of qualifying capital expenditure, and rates of capital allowance, transitional rules for capital allowance, format for deducting capital allowance in computing income tax, some tips for harnessing loss relief and capital allowance, the choice The choice is yours. List of the 22 interdependent compasses and about task up and the authors. Now, distinguished ladies and gentlemen, here you have the key goodies for loss relief and capital allowances in the new Nigerian Tax Act 2025. Here they are. You can now take reasonable risk in business and fully relieve any loss that arises. A tax incentive not available in the past is now available in the new Tax Act. You can now carry forward unrecouped losses to eternity. No more time limit as obtained in the past. You can now absorb all capital allowances due in any year of assessment, whether there is once there is sufficient assessable profit or income. No more restriction as obtained in the past. You can now also carry forward unrecouped capital allowances to eternity. No more time limit as obtained in the past. Capital allowance system now aligns with accounting depreciation system as you have only one rate per annum now, no more initial allowance. The golden rule of tax freedom. Dear friend, can I ask you a simple question? Do you want to be free from tax wahala? No disturbance of your sleep by a taxman. No knocking at your door by a tax lady. No receipt of long queries by your business from a tax controller. No receipt of unsolicited reminders or threats by your company. No blocking of your bank accounts by the tax chairman. No debiting of your bank account at the directive of a tax authority. No barging into you or your business by law enforcement officers. No forceful entry into your business premises by tax officers and law enforcement officers. No threat of imprisonment by a law court. No selling of your business and or its assets without a court order after the tax has become final and conclusive by the Nigerian Revenue Service. Dear friend, if your answer to the above compound question is a capital yes, then obey the golden rule of tax freedom. And you ask, what is this golden rule of tax freedom? And we tell you, it is the 3 C's. And the 3 C's are comply, comply, and comply. Fundamental meaning of loss and loss relief in taxation and how it can benefit you. Generally, in taxation, loss is the negative and unpleasant outcome of business activities in the year of assessment. Loss occurs when the cost and expenses of doing business are higher than gross turnover, income, or disposable proceeds. A loss relief is a deduction granted to a person by the tax law to offset a loss. There are two types of losses in taxation. There is the tax revenue loss and there is the tax capital loss. Tax revenue loss is the excess of allowable costs and expenses of a trade, business, professional vocation over its gross turnover or income in a business period. NTA 2025 puts it this way. For the purpose of ascertaining the profit or loss from any trade, business, professional or vocation called assessable profit or loss, there shall be deducted all expenses for that period wholly and exclusively incurred in the production of the income. Where gross turnover or income exceeds expenses, the result is assessable profit. But where expenses exceed gross turnover or gross income, the result is assessable loss. Tax capital loss is the excess of tax written down value of an asset used for a trade, business, or vocation over its disposable proceeds in the basis period. Similarly, NTA puts it this way. The chargeable gain or loss of an asset used for a trade, business, professional, or vocation is calculated by deducting the residue of the asset, that is the tax written down value, from the disposal proceeds, which itself is calculated by deducting incidental costs and expenses from the amount of consideration. Where the disposal proceed is higher than the tax written down value, a chargeable gain results. And where disposal proceed is less than the tax written down value, a chargeable loss results. NTA 2025 allows deduction of both revenue loss and capital loss from assessable profits or income. For a company, the result is called remainder of assessable profit. And when you deduct capital allowance, you arrive at total profit on which you calculate your tax liability. For individuals, you need to deduct eligible deductions from the total profit to arrive at taxable income or chargeable income on which you will calculate your tax liability. The higher your loss relief and capital allowances, the lower your total taxable or chargeable income, and therefore the lower your tax. And what's the golden rule of loss relief? Please pay attention. The golden rule of loss relief is that loss in taxation is firstly the excess of costs and expenses over gross turnover or income, wholly and exclusively incurred in the production of the gross turnover or income in a basis period, and which the Tax Act allows to be relieved from the amount of the assessable profit or income or the first year of assessment after that in which the loss was incurred, and in subsequent years of assessment until the loss is fully recouped. Please note that the key components of the golden rule of loss relief, as we shall show you now. First, loss is the excess of cost and expenses over gross turnover or income. The costs and expenses being wholly and exclusively incurred in the production of the gross turnover or income in the basis period where the Tax Act allows to be relieved from the amount of the assessable profit or income or the first year of assessment after that in which the loss was incurred, and in subsequent years of assessment until the loss is fully relieved or recouped. This here is a very important considerations that in making laws that you need to know. Please pay close attention to these important considerations in making loss relief. First, loss relief is made by subtracting the amount of unredeemed loss brought forward from the assessable profit or income. The remainder that results, which the Tax Act calls the remainder of assessable profits or income, in paragraph 22 of the first schedule of Nigerian Tax Act, is what you subtract capital allowance to arrive at total profits or income. Graphically, it is like this: assessable profits or income minus loss relief will give you remainder of assessable profit or income. And when you less capital allowance, you have total profit or income. In no circumstance shall the aggregate loss deductions from the assessable profit or income exceed the total amount of that loss. Also, losses incurred in the exempted incomes cannot be relieved from non-exempted profits or incomes. Again, loss can only be deducted from the trade or business in which the loss was incurred. Also, loss shall be deducted to the extent possible from the assessable profit of a trade, business, profession, or vocation of the first year of assessment after that in which the loss was incurred, and in subsequent years until the loss is fully recouped. No more limit. Loss incurred during any year of assessment shall be computed in accordance with the basis provided, which is on the preceding year basis, known in tax circles as PYB, previous year basis. Any loss incurred in any period from sales, disposal, or any other transaction in digital assets shall only be deductible in determining the profits from the business relating to digital or virtual assets. Now, the fundamental meaning of capital allowance in taxation and how it can benefit you. Capital allowance is, as the name announces, simply means an allowance for capital. And capital in this sense means capital asset or capital expenditure. In its full meaning, capital allowance means an allowance which the tax law grants a person for the acquisition and use of an asset or qualifying capital expenditure in a basis period for the production of income in a trade, business, profession, or vocation, which is granted at prescribed annual rates of the cost of the asset over tax estimated life of the asset or qualifying capital expenditure, and deducted from the remainder of the assessable profit or income in determining the total profit or income for a year of assessment until the capital allowance is fully recouped and absorbed. You can see that the capital allowance is an allowance that is granted by the Tax Act to a person who acquires an asset or incurs a qualified capital expenditure and uses such an asset in their business. Capital allowance is the spread and deduction of the cost of an asset over specified periods at prescribed annual rates, which is granted by the Tax Act in place of accounting depreciation. Please note that the capital expenditure or cost of an asset must be a qualifying capital expenditure to qualify for capital allowance. There are three classes and 10 categories of qualifying capital expenditure in the Tax Act, which we shall show you hereinafter. Also, noteworthy is that capital allowance is granted for the use of assets or qualifying capital expenditure in place of depreciation, which is subjective and non-standardized. There is now only one type of capital allowance called allowance in the Nigerian Tax Act 2025. Like loss relief, capital allowance is an allowance which NTA 2025 permits you to deduct from assessable profit or income to arrive at the total profit or income on which you calculate your tax liability if you are a company. But if you are an individual, you have to deduct eligible deductions to arrive at taxable or chargeable income before you can apply the graduated tax rates. Since your tax liability is the product of tax rates and total taxable or chargeable profit or income, it therefore follows that if you want to reduce your income tax liability, you have to increase your losses or capital allowances. Okay, you can do this by spending more money on your capital assets for the good and functionality of your company, your directors, management, and staff. Now, the golden rule of granting capital allowance. The golden rule of granting capital is that capital allowance is an allowance which the tax law grants a person for the acquisition and use of asset or qualifying capital expenditure in a basis period for the production of income in a trade, business, profession, or vocation, which is granted at prescribed annual rates of the cost of the asset over tax estimated life of the asset or qualifying capital expenditure and deducted from the remainder of the assessable profit or income in determining total profit or income for a year of assessment until the capital allowance is fully recouped or absorbed. However, capital allowance is not granted automatically once you buy an asset such as a car, a bus, a generator, a computer, a building, and so on. No, it must pass the golden rule of granting capital allowance, as we know, as we now explain to you. There are 13 key components of the golden rule of granting capital allowance, as we now discuss below. First is that capital allowance is an allowance, it's a relief, it's an incentive. Capital allowance is granted, not obtained automatically. You must apply. Capital allowance is granted by the tax law or act. Capital allowance is granted to a person who may be an individual or a company. Capital allowance is granted for the use of the asset, the subject of capital allowance. The asset or capital expenditure must be a qualifying asset or capex. The qualifying asset or capital expenditure must be used in a trade or business. Capital allowance is granted at prescribed annual rates of cost of the asset or capex. Capital allowance is granted over tax estimated life of the asset or capex, not over accounting estimated life of the asset. Capital allowance is made by deducting it from the remainder of assessable profit or income. When it is deducted from the remainder of assessable profit or income, you have total profit or income. Capital allowance is granted in the basis period in which the qualifying asset was used. Capital allowance is granted on preceding year basis for a year of assessment. Capital allowance is granted until it is fully recouped. No more restriction, no more limit. Singularization of type, rates of capital allowance, no more duality of capital allowance category and rates. In NTA 2025, there's only one type of capital allowance, simply called allowance, for each qualifying capital expenditure category. And this is generated from a single annual rate for each qualifying capital expenditure category. This is a departure from what obtained in the past when you had dual allowances called initial allowance and annual allowance for each qualifying capital expenditure category. And these were generated from dual rates, initial capital allowance rate and annual capital allowance rate for each qualifying capital expenditure category. Now, meaning of qualifying capital expenditure and the 10 types of qualifying capital expenditure. NTA 2025 grouped capital expenditure that qualify for capital allowance into three classes and 10 categories of qualifying capital expenditure and defined qualifying capital expenditure as follows. Qualifying capital expenditure is an expenditure which was incurred in a basis period for the purpose of the acquisition, refurbishment, and improvement of the value of any of the following 10 assets: plant and equipment expenditure, building expenditure, mast expenditure, mining expenditure, agriculture expenditure, intangible assets expenditure, motor vehicle expenditure, heavy transportation expenditure, software expenditure, and furniture and fittings expenditure. Now, types of non-qualifying capital expenditure. The following capital expenditure do now qualify as qualifying capital expenditure. Please note this. Expenditure allowed for deduction as deductions allowed. Expenditure for which VAT, tax, and import duty or levy due was not paid. Capital expenditure which is not acquired, incurred wholly and exclusively for the business. No business capital expenditure. Non-business capital expenditure. Private, personal, and domestic capital expenditure. Excess amount incurred on assets acquired in foreign currencies. These are not qualifying capital expenditure. Very important information for retention of 1% notional amount. In computing your capital allowance, please note this. You have to retain 1% of the qualifying capital expenditure as notional amount until the asset is disposed of or finally put out of use. Understanding the meaning of the golden rule phrase of wholly and exclusively, what wholly and exclusively means. Truly, holiness is largely a question of law and commerce. Consequently, there have been so many legal cases on what exactly wholly and exclusively are. Nigerian case was compounded with the inclusion of necessarily and reasonably. But thank God, those two have been expunged from our new tax act. In UK, there is a whole manual largely devoted to clarification of what constitutes wholly and exclusively. Consequently, you will deepen your knowledge of wholly and exclusively by what is expressly stated, what is covertly implied, and what is neither expressly stated or implicitly stated, and then what it is not. So let us explore the meaning of withholding of wholly and exclusively here. The overall focus of withholding and exclusively is the sole purpose. What is the sole purpose of the expenditure? An asset incurred solely, not primarily for the business, meets wholly and exclusively test. An asset incurred dually for the business does not meet wholly and exclusively test. However, tax authority can apportion where the different components can be clearly identified at their own decision. Wholly and exclusive means qualifying capital expenditure will be taxable as income on the recipient. Key considerations in determining wholly and exclusively of an asset. In determining whether an asset meets the wholly and exclusive test rule, the following considerations have to be made. One, the focus for incurring the asset. What's the focus? The sole purpose of incurring the asset. Whether there was a duality of purpose in incurring the asset, whether there was a primary purpose for incurring the asset, whether there was an ancillary or incidental purpose for incurring the asset, whether the asset is a taxable income on the recipient, finality and recoverability of the asset, who bears the final burden, presentation of sufficient proof of incurrence, whether the asset is incurred, proposed, or estimated, whether the asset is incurred, paid, or accrued, and whether the asset is used for private, personal, or domestic purposes. Claiming and granting of capital allowance. Friend, see, capital allowance is not granted to you automatically by the tax authority. You have to claim it, and you have to do that in writing, not orally. To claim capital allowance, you have to do the following 10 things. First, write to include the capital allowance in your tax computation schedule. You have to write or include the capital allowance in your tax computation schedule. That's the first one. Second one, you have to provide certificate from the Ministry of Industry, Trade and Investment. You have to show proof that the asset is a qualifying capital expenditure. You have to show proof that the asset was used in the basis period. You have to show proof that the asset was in use at the end of the basis period. You have to provide documentary evidence such as invoices, receipts, bills. You have to provide accounting or record evidence. You have to show proof of the wholesomeness, and exclusivity of the asset. You also have to show proof that the asset was used solely for the trade or business. But you also have to show evidence that the supplier is registered for tax and has a tax ID. Where capital allowance is not claimed in the year of assessment, in the basis period for which the asset was used for the purpose of trade or business, it shall be carried forward to the subsequent period. Where capital allowance cannot be deducted fully for a year of assessment due to no remainder of assessable profit or income or insufficient remainder of assessable profit or income, the deduction or any part thereof not yet made shall be treated as a deduction for the next year and for subsequent years until fully utilized, recouped, or absorbed. There is no more limit. You can carry unabsorbed capital allowance to eternity. Where the basic period for a year of assessment is less than 1 year, the capital allowance for that year of assessment shall be granted proportionately. Where the basic period for a year of assessment is a full year, capital allowance shall be granted for a full year, notwithstanding that the asset was used for less. Classes and categories of qualified capital expenditure and rates of capital allowance. Here, you have the 10 categories of qualified capital expenditure into 3 classes with their rates, with their annual rates. So you can go through them. They show you the first class here is contains 5 categories: building expenditure, agriculture expenditure, mass expenditure, intangible assets expenditure, heavy transportation expenditure. Their annual rate are all 10%. For class 2, their annual rates are 20%, and they include plant expenditure, agricultural equipment expenditure, furniture and fittings expenditure, mining expenditure, and other equipment expenditure. Class 3 has 3 categories, and their annual rate is 25% each. And this include motor vehicle expenditure, software expenditure, other capital expenditure. You can go through the list later. Transitional rules for capital allowances. The following are the provisions made by the Nigerian Tax Act for transition of operation or capital allowance from the old system to the new system. Where capital allowance has been granted in respect of an asset before the commencement of the new tax law, the remaining basis period which allowance may be made under NTA shall be the number of years of assessment for which allowance to be made under NTA, less the number of years of assessment for which allowance has previously been made. Graphically, it is shown this way. Remaining basis period equals number of years of assessment under the new Nigerian Tax Act are less number of years of assessment previously made. Where capital allowance has been granted in respect of an asset before the commencement of NTA 24 years of assessment equal up to or greater than the number of years available, a single allowance shall be granted for the residue upon commencement of NTA, provided that 1% of the qualifying capital expenditure shall be retained as the notional amount. Format for deducting loss and capital allowance in computing income tax. This will also help you to know how to reduce your tax. So for loss and capital allowance, there are line items in the table for computing income tax. So we have the table here that shows how to compute tax for a company and also how to compute tax for individuals. The first item on the list is your gross turnover or income. When you less allowable cost and expenses, you come down to what you have as profit before tax. And when you less loss brought forward, you now have the remainder of assessable profit. And when you less capital allowances, you now have total profit. For companies, you end here. But for individuals, you have to less eligible expenses, and you come down to what you call either taxable profit or income or chargeable profit or income. It is on this chargeable profit or income or taxable income that you now multiply your uh, tax rate. For companies, it is 30%, and for individuals, it's graduated to 25%. So, with that, you have your computed tax liability. Now, some tips for harnessing loss relief and capital allowance. Please be proactive. Seek advice timely when necessary. Know your tax law well. Know your loss relief and capital allowance law well. Keep a comprehensive register of all tax benefits and incentives. Keep a comprehensive register for all tax compliances. Your capital expenditures must be your capital expenditure must belong to any of the three classes of the qualifying capital expenditure. Your capital expenditure also must belong to any of the 10 categories of qualifying capital expenditure. Ensure the asset qualifies as a qualifying capital expenditure. Ensure that the asset meets the golden rule of wholly and exclusively. Ensure that the asset was acquired for the sole purpose of the business. Ensure that the asset was acquired and used in the business period. Ensure that the asset was in use at the end of the business period. Ensure that all VAT, taxes, duties, and levies were paid on the assets, otherwise, they will be disqualified. Also, calculate capital allowance accurately and timely. Submit claims for capital allowance accurately and timely. Always obtain capital expenditure certificate from the Ministry of Trade, Investment, and Industry. Also, charge all chargeables, pay all payables, remit all remittable. Obtain and keep documentary evidence of all assets. Keep comprehensive and accurate record of business transactions. Most importantly, regularly consult or hand over your tax matters to Tax Corp. The choice is yours. Friend, you have seen the provisions of the Tax Act over loss and loss relief, qualifying capital institution, capital allowances, and all that. The choice is yours. You can reduce your tax by utilizing all these. And you know what? Tax Corp will always be there for you. So here you have the list of the 22 interdependent compasses. It is left for you to go through any problem you have, any particular tax subject you might have. All that you need to do is to just pick what you want and we'll deal with it accordingly. Well, here is about Tax Corp. Tax Corp is the Nigerian tax consultant firm which specializes in tax matters. Prince Chidi, FCA, FTTI, MBA, is the principal consultant. Prince Chidi is a licensed fellow of the Institute of Chartered Accountants of Nigeria, ICANN, and the Chartered Institute of Taxation of Nigeria, CITN. Tax Corp and Prince Chidi have provided tax services to numerous individuals and corporate bodies in both the public and private sectors locally and internationally since 1990. That's about over 3 decades. The beneficiaries include the Nigerian Revenue Service, formerly the Federal Inland Revenue Service, Revenue Mobilization Allocation and Fiscal Commission, State Internal Revenue Services, so many of them, Federal Capital Territory Internal Revenue Service, and many private companies and individuals. You have our information, contact information. Should you desire anything, please do contact us. Drop your comments in the comment section or use any other channel to contact Task Hub. Thank you and have a nice day.